Welcome to Remarkable Retail Podcast, Season 11, Episode 7. I'm Michael LeBlanc.
And I'm Steve Dennis.
Our guest this episode is David Boone, CEO of Michaels. I met David here in Canada in his role as president of Staples Canada, guiding that retailer through private equity ownership, the COVID era, and leaving a much, much stronger retailer. Now he's in Texas at Michaels. We talk about how they are thinking strategically and opportunistically about both the disruption in the craft space and continuing to build community across North America. First in the news, we're going to talk about the big AI commerce news of the week with Walmart's deal with ChatGPT, remarkable Aritzia, LVMH sector news, and what, if anything, Levi's results tell us about the future of DTC. And then we'll visit the opposite end of the optimism spectrum with Saks. We'll be back after our time with David, and we're going to talk about what we each found most remarkable this week and what's on our radar screen for the weeks ahead. Steve, you know, it's that time of the year when a young man's thoughts turn to the NRF Big Show in January, and we've got news.
Yeah, we do. Actually, I was thinking it's the time of year where we start saying Black Friday, Cyber Monday in every other breath. But yes, also the NRF Big Show is coming up. I'm sure most of our listeners know that's held in New York. Every year, 35, 40,000 of our closest friends get together. So that's less than 3 months away. But our news is that we will be partnering with Narvar, the intelligent customer experience platform that focuses on the post-purchase journey, which mostly means dealing with returns, but other things as well. They will be hosting our remote podcast studio. So we'll be talking about that more in the weeks to come with a lot more details. But that also reminds me, for any of our listeners out there that want to partner with us for other events next year, like Shop Talk, the World Retail Congress, we are working on that right now. So if you are interested in partnering with us for a remote podcast studio or some sort of events around those events, reach out to us in the weeks ahead. We'd love to chat with you.
All right, let's get to the news of the week. Hot on the heels of a great episode where we talked with Scott Wingo about agentic commerce, Walmart makes what some people are describing, Scott, for example, as some of the biggest news of the year, very potentially transformational. A deal with OpenAI, maybe not as big as ChatGPT opening up to porn to make some of their money back, but still pretty important.
Yeah, actually,
this?
This morning I was listening to the Pivot podcast, and Scott Galloway was citing some of the web traffic statistics related to pornography. So if you're particularly interested in that, go listen to Pivot, but then come back. But yeah, ChatGPT has made quite a lot of news in the last week or so. They've done several big deals with Etsy, I think DoorDash, a bunch of others. But the Walmart news was the one I think that captured most people's attention last week. It's still a bit unclear, but the main thing is that you will be able to basically transact, do e-commerce straight from ChatGPT to Walmart. So we've talked about various aspects of this, and a lot of the details are really TBD. We don't have a launch date. What I think is going on with Walmart and others is you've just got to be where the customers are. And if more and more customers are going to ChatGPT or other AI-related search engines or apps, super apps, I guess you could call them, and doing their queries there, then you need to be there, and you need to try to do what you can to position yourself to capture that traffic and to capture those sales. So I think it's a good example of Walmart really staying at the forefront of technology, taking, I don't know if this is a really big swing or particularly risky swing, but it is really interesting how fast things are moving. So more to come on the details of this and when it'll actually be live, but I suspect a lot more to come with other partnerships on the parts of big retailers with OpenAI and others.
So we've got some earnings starting to roll out and some lessons from those earnings. So let's start with LVMH.
Yeah, just a couple. So these are really the retailers that report on their more regular quarterly schedules. I suspect most people know a lot of retailers are 1 month off. So we'll be getting most retail earnings in about a month. But the big news, I guess, from LVMH is after multiple quarters of pretty sluggish earnings, they signaled or they reported a bit of a turnaround. So their sales were up just about 1 or 2% on if you adjust the currency basis, which I'm sure people are super fascinated by. And so some folks were interpreting this as perhaps a signal for a turnaround in the luxury sector. Now, as longtime listeners will know, luxury's been going through kind of a rough go of it for the past year, which is a little bit unusual given the strength of the economy overall and the rich getting richer, but that's probably a topic for a different day. And in fact, we are going to come back with more of a luxury deep dive in just a few weeks. So I won't spend too much time on this, but I think it's a little premature. It's certainly encouraging to see the sales trends reverse, but there's still a lot of issues in the luxury market writ large. So I'm not ready to declare some massive change. And one piece of evidence on that, another luxury retailer whose news we got this week was from Saks Global. So this is the combined Saks Fifth Avenue and Neiman Marcus businesses, which we've talked about a bunch. Their results were pretty terrible. Significant sales drops, double-digit sales drops, significant losses. In fact, the operating losses got a bit worse. They are, of course, blaming some of the inventory issues that we've talked about multiple times for the past, 9 or 10 months at this point. And of course, they're going through a lot of integration of the Neiman Marcus and Saks businesses. And that is, I'm sure, quite complex and makes it more difficult to execute, I'm sure. But still, objectively, these results are terrible. Mark Metrick, their CEO, basically was signaling a more optimistic tone that they've identified a tremendous amount of cost savings, which will start to be seen in the future, that they're getting back on track with some of their vendors, that their major vendors are being paid. I will mention one thing very quickly about that. Part of what makes Neiman Marcus and Saks interesting is, of course, they have the very, very top brands, but those same very top brands have lots of their own stores. So part of the differentiation for Saks and Neiman's is to have brands that aren't available everywhere. And I'm afraid that, and I've talked to some former Neiman's employees about it, that is a real vulnerability. So anyway, we shall see. I think it's fair to say you can't really judge where they are given the degree of change they're going through. But, when you lose that kind of volume, it's not easy to win it back. So they're very huge, $8 billion player or something like that. So that's pretty significant to U.S. retail anyway.
So fun factoid, I worked for Levi's back in the late 90s and sold the very, very first pair of Levi's jeans online in the world. And so I've got a special place in my heart for Levi's and a bit of their direct-to-consumer. So they had some news around
was
their
that pair
DTC.
Returned, though? Was the first pair returned?
Well, the funny thing is we sold it, and then I went to the closet where the inventory was, and they'd sold the inventory to Sears. So I had to go to Sears and buy the first pair of jeans that were then sold by
What's
Levi's.
the margin on that?
The margin was not good, but we were very happy to have the one sale for that month. Early days. Now, early days, how's it going today, 25 years later?
Well, Levi's is an interesting story. First of all, for those of you who need some career advice, we give special props to Michelle Gass for getting the hell out of Kohl's and moving over to Levi's, which is objectively going much, much better. But Levi's is a really interesting brand. On the one hand, they are kind of a mid-market brand, and I'm sure people have heard me speak ad nauseum about the collapse of the middle. And of course, Levi's is also pretty famously got very significant distribution in moderate department stores. So they're not, in some sense, exactly well-positioned. But their business has been improving and is really pretty good. I think the thing that is most interesting is their investment in their direct-to-consumer strategy. So not only, as you mentioned, they've been online for quite a long time, so that's not new, but they are and have been investing very significantly in their own stores, and they've got quite a lot already. But they, number one, saw better results in the direct-to-consumer channel, which does have the potential for better margins and obviously a direct relationship with the customer, diversifies them away from the exposure to the moderate department store sector. Yep. But they also said they're thinking about potentially doubling their own store count. That would be quite a lot of stores. The only downside really in what was a pretty positive earnings report was they are, of course, going to experience tariff headwinds. And Wall Street did not love that, even though it's hard to imagine that was unexpected given what we know about the tariffs and what we know about their potential exposure there.
It's interesting. When I worked there, the philosophy, which still carried over from the family, was that they were going to make jeans in every country they operated in. So they made them here in Canada, made them in the U.S., made them wherever, which would actually do them quite well these days. At the time, the pricing got a little bit tough to compete. But fast forward 25 years, it doesn't sound like too bad a strategy the way the tariffs are sorting through. Let's talk about a great Canadian retailer that you and I are big fans of. We visited their stores and toured them. They're just fantastic stores. Aritzia, what do you think of their results?
I'm shocked that you mentioned that they were a Canadian retailer. That caught me totally by surprise. Yeah, the way I wrote this down, I mean, we have been paying attention to Aritzia, but I guess we are, not that we give out badges or anything, but Aritzia is now officially on our remarkable radar because they are performing extremely well, but also I think getting to a size and scope that a lot more of our, at least North American audience will be noticing. So they reported a 32% increase in revenue for the second quarter. Very strong,
32%.
like crazy strong, double-digit comps in both their physical and their e-commerce channel. As you mentioned, they started in Canada, but they've also been expanding quite aggressively in the United States. So the U.S. accounted for 60% of their incremental growth. Now, obviously not surprising, U.S. is a much bigger country, so to the extent that they have gotten a good foothold here, but are expanding quite aggressively. That's not terribly surprising. But also from a profitability standpoint, despite certainly some exposure to tariffs, their net income rose more than 200%. So when we're seeing quite a lot of companies, particularly apparel companies, really seeing both a slowdown, but being hit pretty extensively by profit headwinds. It's I don't know if I've quite put it in the Abercrombie and Fitch remarkable trajectory, but they are getting a lot closer to that. Now, I don't know. I know you talked to Brian Hill recently. I don't know if you have anything, and mentioned that, I think, a couple of weeks ago. Anything else you'd add to the Aritzia story?
Well, I would just say there's so much potential in the U.S. market because he was sharing their unprompted awareness was really, really low, like low single digits. So from him, he was very excited because he said, oh, my goodness, nobody knows about us. And we're still putting these kind of numbers on the board. So they saw that as just a tremendous opportunity for growth. Not surprising, most of the growth would come from the U.S. They've been around almost 40 years in Canada. So they've been around quite a while, So the U.S. and beyond, but they could spend the next 20 years in the U.S. in the American market and do quite well based on the numbers that he shared. Yeah. So really fantastic. All right, that's a wrap on the news. Now let's get to our amazing interview with David Boone from Michaels. Then we'll be back and we'll finish off with what's on our radar screen and what we're finding remarkable this week. David, welcome to the Remarkable Retail Podcast. How are you, my friend?
I'm great. Thank you for having me today.
Well, I'm excited. I haven't seen you in a little bit, and last time you and I were having dinner together at a Retail Council of Canada event, and now you've moved to Michaels, so I'm excited to catch up. So obviously we know each other at least a little bit from your time spent here in Canada, but perhaps folks who are listening do not know you so well. So let's start talking about yourself, a little bit of your background, your experience, and what you do for a living today.
Yeah, sure. So I started my career at LeBlanc companies, big, large Canadian food, drug, and general merchandise retailer, and spent quite a bit of time there across all different functions. Had a brief tenure in banking here in the United States. Went back to Canada to run Staples Canada. Came back to the U.S. and most recently ran a wholesale and e-commerce fulfillment company out of Chicago called Descendant. And earlier this year, was fortunate enough to join Michaels as CEO.
Michaels, certainly a familiar name across North America. You got stores both U.S. and Canada, but for the listeners, give us a sense of, not just the scope and scale, but what should they know about the business and essentially what makes it so successful?
Well, a couple things. So, scope and scale, I think, is what we're over 1,300 stores across North America, as you pointed out. We have a pretty strong digital presence. A couple things that I think your listeners might not know is that we're also a pretty large manufacturer of custom frames, I think the largest in North America. And we have basically 3 manufacturing and finishing sites, one in Mississauga, just outside Toronto, one in North Carolina, and one here in the Dallas-Fort Worth area. So that is, certainly something unique for our organization. And I think some of the other things, people tend to think of us as an arts and crafts retailer. But the reality is we're much more than that. Obviously, arts, crafts, and creativity at the center of what we do. But we've got pretty strong positions in decor categories and an emerging position in I would call it celebrations and party category.
So maybe we could pick up on that a little bit more in terms of talking about how you would describe the Michaels customer today. Obviously, as you just shared, there's some variety there, but how would you describe them? And from your perspective, how are their needs and wants and expectations changing?
At its fundamental basis, our customers are creators, meaning, and they may be doing it for themselves. They may be doing it when they entertain. They may be doing it to resell product on to their friends. And in fact, many of them donate what they do. And so what we do as an organization, we have all the products and a whole bunch of services that help people do that. And what is interesting about the business is it's everything from being an artist to somebody who sews or knits to kids that do creative crafts. So everything to help with that creative lifestyle. And again, what we're finding very interesting in what we're doing today and compelling is there's a whole side of our customers and communities in general that are looking to personalize it and add creativity to celebrations and to every part of their life. And so as a business, what we're trying to do is empower that.
And I was saying off mic that it seemed like I was going to a Michaels store every few days when my kids were much younger, but I'm not as close to the business model today as I used to be since they're grown-ups. But, obviously one of the big differences over time has been the rise of digital shopping. And I think I've seen you and others from your organization comment about how important it is to be truly omnichannel. Now, omnichannel is obviously not a new idea, but how would you define that today? And how are digital and physical working together to respond to those customers' needs?
Yeah, so I think it's an interesting question. I would just sort of go on your point that it's not a new concept, right? Omnichannel has been around for quite a while. And so for us, what Michaels has been doing over the past several years has actually been investing quite a bit of money in our digital experience, which we view not only from a transactional point of view, but almost the front end of our total ecosystem. And so omnichannel is making sure that what our customers see online or can explore online, they can transact, and then they can also come in store and continue to transact or have a relatively seamless experience. And so for us, here's an example. We recently expanded into the balloons and party business. And as part of that, one of the customer need states was to be able to schedule in advance to pick up their balloons. So think about when your kids were young, maybe you wanted to have a party on Saturday afternoon and you had to run around and grab a whole bunch of stuff. Well, people wanted to order on Wednesday, pick their balloons, have it organized. And so we built a pre-scheduling functionality, including all of the in-store processes and scheduling so that an hour before you're going to show up to pick up your balloons at 1 p.m. on Saturday, we've blown them up. They're ready to go, and they're in a package that you can take them home in.
I'm curious, with your Staples experience and now being at Michaels, was there anything that really surprised you, whether that was from a customer experience standpoint or maybe technology investments that you had to make? I'm thinking, specifically to kind of the merging of the channels, but maybe I can ask that question even more broadly.
Well, I would say here's a couple differences and some similarities. So certainly the time at Staples, the mix of that business is consumer, educators, and B2B. And B2B is a pretty significant part of that business. Michaels is primarily B2C. We do have some B2B programs, but we're primarily consumer focused. The category differences in the engagement in the category are very different. So Staples provides products and services to help businesses and consumers be productive in their lives. And Michaels helps people create. And it's very much an enthusiast category. And so what that means is how we go to market for our customers, whether it's digital or in-store, is meaningfully different than how a Staples would go to market. And in fact, what I would suggest to you, just relative to retail in general, is our stores as a channel are more important to our customers because they want to touch and feel fabric and products and be inspired. And they enjoy the process of walking around the store and think about different things they could do with the products we sell, much more so than other categories I've been involved in.
One of the ways that I've talked about that over the years, and at one level, it's pretty obvious, right? There's the things that are basically kind of functional, needs versus wants. And what I hear you saying is it's bringing more of that emotional content. What they do speaks more to who they are as opposed to just getting something off their to-do list, even though.
I think your description of that's who they are is probably a very apropos description of, our customers are creative types. They want to be around creative people and they want to be around products and services that inspire them.
And is there any particular way that, I guess I'm looking for techniques or just processes for our audience where you are able to really discern what customers are looking for? Because I find in my history, when you've got just kind of features and benefits to compare, like that's relatively easy to understand from a research or customer insight or customer journey mapping point of view. But it gets a little bit harder when that emotional content comes into play. I don't know if you agree with that as a statement, but if you do, are there any things you've discovered perhaps that are more impactful at Michaels than maybe in your prior lives?
So I think it's interesting, maybe harder to quantify. And what I would just highlight is since I've joined, we're on a journey to make sure that our retail experience lives up to that aspiration. And we clearly have a bunch of it today, but there's more to do. I think judgmentally for me, it comes down to the team members that we have, both in the store support center, the home office, and the stores, and allowing them to bring their creativity to life. And that is very judgmental in nature, right? Like we can do a lot of customer research, et cetera, and we learn these things about why people like us. But when the category manager for a particular category is excited, interested, knows that craft, that creative area, and says, hey, this is a good idea, it's difficult as a senior executive to, if you don't participate in that particular activity, to really understand it. And so you have to have people that you're willing to listen to guide you in terms of making sure that you have the products on the shelf and in the environment that are going to resonate with those particular customer segments.
We'll be right back after these messages. Promotional support for the Remarkable Retail podcast is provided by Crave Retail. What's retail's biggest blind spot? The fitting room. A shopper wants to buy, but can't get the help they need. That's why global brands partner with Crave Retail, the market leader in smart fitting rooms. Crave connects that moment to your business, giving shoppers a voice, associates real-time alerts, and teams the data to buy smarter. The result? Higher conversion, better decisions, a seamless experience. Learn how fast you can elevate your fitting rooms at craveretail.com. Promotional support for the show comes from Find Mine. In the time it takes to listen to this ad, your team could have leveled up their productivity by 90% and set up your brand for increased sales. Find Mine's AI tools let you run operations on thousands of products right now. Get self-service AI to support product tagging for better success with AI agents, dynamic programmatic ads for Meta, visually similar product recs, complete the look styling, trend and campaign curations. Find Mine's innovative enterprise platform currently generates breakthrough customer experiences for top brands like Lululemon and Ann Taylor. See what Find Mine can do for you and join the waitlist at findmine.com/remarkable retail. If the world has changed so very, very much, why have so many organizations changed so little? As the pace of disruption accelerates, leaders need the courage and the insight to aim higher in the value they deliver, move faster than they ever have before, and take the bold action to leap ahead of the competition. With Leaders Leap, Transforming Your Company at the Speed of Disruption, Steve's latest breakthrough bestseller, you'll discover why so many companies fall into the trap of the timid transformation. More than anything, you'll learn about the essential mind leaps leaders need to make to win the future. Leaders Leap is available just about everywhere books are sold, as well as on Audible and as an ebook on Kindle for just $9.99. David, shifting gears a little bit, let's talk about operating the business in Canada at Staples. You are operating a private equity-owned company. You are, again, does that ownership structure make a difference? Are you gravitating to it as an operating some place you prefer to operate? And talk about the difference of operating. You've done both, but what's it like working in the private equity realm?
Yeah, so as you mentioned, I've worked in both public companies and private, and so and both in retail and financial services. So the one kind of common truth is if you're not relevant for customers and delivering a value proposition, the ownership structure doesn't matter, right? So, customers don't walk into the store or go online and determine that you were private equity owned or whatever. So,
right.
So I think we've got to there's a lot of conversation around that. I get asked that question a lot, and I'm always just like, okay, well, that's great, but let's figure out how we're going to win in the marketplace. And then whatever ownership structure you have is likely going to be happy. That being said, I think there's obviously pros and cons. Certainly in the private equity space, I would say decision-making can be faster than in the public space. Would probably be one of the benefits, I think, of the private equity model for ownership of companies. On the other hand, in a public company, although your results are visible, your brand might be a little bit more visible out there as well. So I'd say pros and cons.
Just talking about that speed of decision making, I want to reflect on the closures of Party City and JoAnn's. It really created a white space in your space, and was that an enabler for you to seize on that opportunity so quickly, or were there other factors at play?
Being private equity owned, I think the answer is probably yes. Look, we came into this year with a point of view that Michaels is a great brand with a great following of customers, but likely needs some transformation. We need to improve our store experience. We need to continue to make our products more relevant. If you're closely following us, we've reintroduced in-store classes, et cetera. So all of that stuff needs to happen and is getting some acceleration. But we started the year with, hey, there's an opportunity in the market, and we internally called it seize the moment. And we have gone as fast as possible to basically launch both a digital and in-store kind of shop within shop, one, the party shop at Michael's and a balloon bar. And then we introduced Knit and Sew Shop, which is combined with our brand, and we acquired the intellectual property of JoAnn's. And I think I can't say it's directly to the ownership structure. I'd attribute it to our team here. We just felt like we had to move fast. There was millions of consumers looking for homes for those types of purchases. And if we didn't step up, we didn't know who would, and it would probably get dispersed. And so that's the opportunity we've been pursuing at expense of almost every other initiative in the company.
So, we talk a lot about innovation on the podcast, and I guess trying to balance speed and risk and being on offense, being on defense, those kinds of things. So I'm wondering if there's any, it's very exciting. You got all those initiatives going, and it does seem at one level like you do have to seize the moment because there's so much volume at play. And maybe, and I guess you can tell me if this is true, maybe it's not as risky to go fast and big and bold on this sort of opportunity because you've got the track record. You kind of know what the size of Party City and JoAnn's business looked like and what sort of product lines they had and which were successful and so forth. Is that true? And then I guess, what does that say from your overall experience about seizing opportunities and how much risk you should lean into?
Yeah. So I would give you kind of two thoughts on it. So, we took the point of view here that not being bold, acting fast, investing in inventory, rolling out some things without piloting it would be a mistake. That the bigger risk for the company would be to not go after this and take some more risk. And we're now, based on how we're seeing consumers respond to it, and let's be clear, we weren't perfect in everything we're doing. We're starting to think through, okay, so on a go-forward basis, do we need to apply that amount of pressure to 2 or 3 big things every year? that we know are reasonably good bets for going after space in the marketplace, and let everything else kind of continue to improve as businesses need to do, and apply that sort of ethos across the business. So the answer is there's a risk by not going big and bold in certain things. The second thing I would say is, and I've seen this just about everywhere, everybody who works in retail in our industry, there are always 1,000 things to improve on your core processes. Like every day you could look at whether it's how you schedule people in store, whether it's a supply chain initiative, whether it's, the next version of marketing. You can always be better at everything. And that's what we do every day. But you got to find time and space to put new stuff in there. Otherwise, you're not kind of transforming the model. And so I think my role is really making sure that we wedge in new things, innovation, risk-taking at pace so that we can continue to be relevant for the next, 10, 20 years.
So one thing I'd love to follow up on is, as you may know, both Michael and I, earlier in our careers, were two very large retailers that aren't around anymore.
Yeah.
And Michael can speak for himself, but one of the things I observed in my 12 years at Sears, particularly the couple times that I worked more on strategy and innovation, was it was very hard to get the leadership team to realize the price of inaction. It's very easy to say, if we open this new concept store, that's going to cost so much money, and we got to explain to the board the ROI, yada, yada. So it's very easy to defend the status quo, or easier in many cases to defend the status quo, but to say, but the price of inaction is actually greater, or potentially greater. I'm just curious if you have any lessons for our audience as to how to shift that perspective on risk. And really, it's, I guess, the classic kind of innovator's dilemma. But, any other ideas on that?
I think, it is exactly a dilemma, right? Especially if there's no burning platform. And chances are by the time there's a burning platform, it might be too late, to your point. I would say, to the extent you can quantify the risk so that people fully understand the downside of it. In our case, we're expanding dramatically and we're going to overbuy some inventory. And, if the sales appear, we're all going to love it. And if the sales don't appear, it's going to take us a little bit while to work out the inventory. And here's kind of the quantity of that. And so I think to the extent you can quantify the downsides, both strategic and at least financial, so people know what it is against the upside, honestly, that's the best advice I can give, other than philosophically, we've got to wedge some of this stuff in here.
Well, it's funny, and maybe we'll cut this out because it's a little bit of a sidetrack. But when I was working at one company and trying to push forward an innovation agenda, this is almost 20 years ago now, I was trying to get about $50,000 to experiment on this thing called Facebook, some social media advertising.
Yeah.
And my boss, who was the CEO, said, that seems pretty risky. And I said, well, it's an experiment. And he said, well, it just sounds like a lot of risk. And I was like, we buy hundreds of millions of dollars of inventory every month that we're not really sure what it's going to sell for. And it was funny to me, particularly in retail where you're taking risks on inventory all the time. This was a fashion retailer, so you could argue it's a little bit more risky than
for sure
some other product categories. But still, it's very comfortable doing that. Or we'd spend all this artwork on our stores.
Business as usual versus new, right?
Yeah. So I don't know if that maybe just speaks to human nature rather than business strategy. But anyway,
potentially. Understood.
I think some of those discussions are happening around agentic AI and all the different permutations of that, even right now.
I think some of the things we should think about in terms of those risk taking is, there's small risks, but what I like to ensure that we do is, if we're going to try a bunch of new things, is to figure out that we're going to try things that we think if they hit and we scale them, they're going to be a winner and they could move the needle. There are a lot of things that, people want to try, and it's natural, right? You see sort of this improvement here or there, and it's not going to scale into something that's going to move the needle for our customers or for our business. And then I think, well, let's not pursue that. Let's focus on a bunch of risks that we're going to take that if one of them hits, we could really scale it and improve the performance of the organization.
Right on. Now, for the brand folks out there, the marketing people, you find yourself in an interesting place where you've got JoAnn's brand and other brands, and you're going to be integrating them into the Michaels experience. You've articulated how they're going to form. But as you think about bringing in these other brands, how do you think about integrating that into the Michaels brand?
So Michaels is our master brand, and obviously that is at the top of the house. And, we've really spent a lot of time thinking about how we communicate with that brand, our purpose, which is to fuel the joy of creativity and celebration. And then so everything else is subservient to what our purpose is in life. With respect to JoAnn, I've been asked the question before, which is, well, why did you buy the IP and what are you doing with it? And for people that sew or knit, JoAnn's was very much a beloved brand, and it was a happy place for a lot of people. And so in conjunction with rolling out the knit and sew shops, we decided deliberately to use the JoAnn's brand alongside of Michaels to sort of instantly communicate to those customers that we had the products that they need and that we could bring some semblance of what was beloved in JoAnn's into a Michaels store. And so we just felt a very deliberate communicative step. Otherwise, we would have spent years doing it. And then we've tried to speak to those customers and hold in-store events. We had a VIP day where we invited in all of the new JoAnn's customers to our stores and hosted them. And there was, coffee and cake and all that stuff to introduce them to what the experience would be at Michaels, which would be different than JoAnn's, would be sort of our version of it. So it was very specific to that. With respect to introducing a store within store, the Party Shop at Michaels, again, it's our brand, but what we wanted to be able to do is to communicate to customers who might not naturally think of Michaels as a party celebration destination,
right?
To be very deliberate about it, which is why we were sort of decided to go bigger and bolder, which we don't feel the need to do in other categories.
Interesting. It's fascinating because there's two examples of this happening in North America with Canadian Tire and Hudson's Bay, right, where they've bought the IP and are conceiving of what they're going to do with it. Let's wrap up with this whole discussion's been a great masterclass in things like taking risk and brand development. But are there any lessons you'd like to share with the listeners about when you did these initiatives? That here's what are the two or three keys to absolutely making it successful.
So I'm going to start with one which is maybe a little bit interesting to say, which is none of these initiatives are going to go smoothly. And if you believe in them, my number one advice to people is you got to keep going and adjust and keep going and adjust. Like none of these rollouts have gone as smoothly as the project plan that we had when we started. Some vendor issue will happen. Tariffs happened in the middle of it for us. So we just had to adjust and keep going. And so I think if you believe in something, is keep going. I think you have to fight. If you're doing something big and bold, collectively with your team, you kind of have to fight some of the business as usual processes that are designed to protect the company from making big mistakes. Which are important in everyday business, but you have to fight some of those. And, my experience is that requires very much personal leadership. And what I learned is, everybody wanted this to happen, but we're working in their ways of working within the organization. And that was my role to sort of break some glass and kind of say, it's okay. Right. So it's okay to go spend X millions of dollars on this inventory, even though we're not 100% sure how that's going to work, and make it safe for those folks to do that. So those are a couple of the lessons that I would reflect on over the past few months here.
Fantastic.
Well, it's exciting to see everything you've got going on. It's also, being based in Dallas as well. It's exciting to see a Dallas retailer. It's been a kind of a ride with some of the gyrations in the market here for retail in the last few years.
We are definitely on the move here at Michaels, and it's exciting for our team members as well. So,
well, we wish you the best of luck, of course, and we'll be very eager to follow all the exciting developments. And Michael and I just want to thank you for taking some time to share the Michaels story on the Remarkable Retail Podcast.
Thank you so much, Steve. Thank you, Michael. All the best.
All right, we're back. Steve, what are some of the most interesting stories we should be talking about this week?
Well, we try to find things that are, I guess, buzzworthy or have a little bit different dimension maybe than we talk about in the first part of the podcast. And one of the things that definitely caught my attention, and actually quite a lot of things caught my attention this week, so it's really hard to boil them down, but OpenAI released their Sora social video app. And I don't know about your social media feed, but my feed featured several folks that I know, including previous podcast guest David Katz, floating through the air, holding a cat, also dancing in like a Motown kind of video. But and I haven't really played around with it too much, but I understand, number one, it's pretty easy to use. But what's really interesting is how realistic these videos are. And I always talk about the speed of disruption. We've talked about generative AI having this rapid adoption rate, but it's just mind-blowing how fast things are picked up. So OpenAI Sora had 5 million downloads in its first, I think, 72 hours, despite being invite only. So I don't know. It's frightening to me at one level just how fast some of this hyper-realistic AI stuff. And I think of the fun and positive aspects of it, but I also get quite nervous about some of the destructive forces, including some things we've seen from our U.S. government here. But anyway, I found that interesting. The other one in a completely different vein, I guess, is, and we've talked about the GLP impact, but this week, it seems like everything that can have protein added has protein added. I think we should say that the Remarkable Retail podcast now with 19 grams of protein.
Extra dose.
So yes, we understand this because of well, there's both the intersection of the GLP-1 drug effect and people needing to change their macronutrient consumption, or they should change their macronutrient consumption, but also just kind of this fascination with the need for more protein, and frankly, more protein than we actually need, but I'll leave that to the nutritionists and doctors to deal with. But of course, the big news of the week is that Pop-Tarts now are available with extra protein. So I think you might want to evaluate your life choices if you think that Pop-Tarts with protein is a good nutritional choice. But nevertheless, here we are. And if prices continue to come down for these drugs, I guess that'll just be more Pop-Tarts and more things with protein.
Well, fun fact, and in defense of Pop-Tarts, there are two items that are the number 1 and 2 items sold whenever there's bad weather, hurricanes coming to any region, and that is bottled water and 2, Pop-Tarts, because everybody loves Pop-Tarts. So there you go.
And it is obviously a complete meal in a foil pack.
I wanted to lift up out of the mud. I'm doing a little fun there. I met this amazing founder this week from Australia here, and she was getting a listing with a small independent retailer, Hops and Grace. And it's the brand called Mudd, M-U-D-D. They got a couple of stores. They got 10 stores worldwide. They got one in Manhattan. They make the most amazing bespoke drinkware and servingware, all out of clay. It's very beautiful stuff. In fact, she said, "Who is this Aritzia guy? I just got this order from." All this orders from Aritzia. It turns out Aritzia is using them in their cafes. And anyway, shout out to Shelley Simpson. We had a great interview, and I met this founder, and she's just the epitome of everything you talk about in terms of focus and not trying to be everything to everyone. She's got her 30 years straight on, and her growth is, she's small, very, relatively small player, but knows what she's about. And it's picking her retailers, and she's got some stores. So anybody happen to be in Manhattan, visit the Mudd, M-U-D-D store, or any of their 10 around the world. Big, great Australian retailer.
Check that out.
That's around the corner. What are you thinking about?
Well, a few things I'm keeping on my radar screen. Again, this is a place where there's like so much going on. It just seems like way more than usual, perhaps. But I think one thing, just since we've been talking about AI quite a lot, but last week's episode and a bit this week, is it does seem like the notion that an AI bubble exists and there's a risk of it bursting seems to keep growing. It's been in the news a lot. First of all, not that we're a stock market or investment podcast, but those that follow that will know about the Mag 7, the 7 magnificent stocks that most of them are AI related. Tesla, not so much, but NVIDIA, Alphabet, et cetera. Those stocks have driven a huge amount of the increase in the stock market, and the multiples, and just about every way you look at them, you really have to believe a lot of both effectiveness and efficiency is going to come out of AI for those valuations to make any sense. People, those of you that were around through the internet bubble bursting, there's a lot of, if you look at what was going on pre-internet bubble, there's a lot of similarities. I'm not going to weigh in on my particular opinion about it, just to say that this talk is really escalating, and whether that will lead to the bubble bursting or whether that will just lead to people going like it's all going to be fine. But one thing not to promote the Pivot podcast too much, but one thing that Scott Galloway said, I think a couple of weeks ago now, that I was reminded of, is he said, if you look at the U.S. economy, it's basically a big bet on AI because, again, so much of the capital spending, I know you've talked about this a bunch of times, so much investment is going into AI, whether it's these Mag 7 companies, startups, building of infrastructure, you name it. And that is propelling GDP. It's propelling certain aspects of the economy. So if that bet is wrong, it's tariff-free. So if that bet is wrong, things could get a little bit ugly. But then one last story very quickly. We talked last week or the week before about this study or survey of retail store managers who were warned about out of stocks. Well, two things. I was looking at some statistics for, this is a word I love, containerized imports. So this would be stuff coming over in a container via ship to the U.S. fell 8.4% year over year in September. Now, last week we just talked about how retail sales are up quite a lot. Now, you can't quite tie imports to total retail, right? But this is really, I think, very suggestive of the impact of tariffs and the impact of supply chains being reconfigured. 23% of that drop was from China. So that is also supportive of perhaps some out-of-stock issues that we might be seeing here in the fourth quarter. I did happen to, as I do, because I got that kind of time apparently, I did do some store visits this week, and I'll spare you the details on it. But I do, a little bit, but mostly online, even though physical retail isn't dead, I do like e-commerce, I have to say. Anyway, I did do some other shopping, and maybe we'll talk about that another time. But the specific thing related to this story was I did notice going through a couple of Targets and a couple of Kohl's. Now, this is just in the Dallas market, so this may not be representative. Your local mileage may vary. But I noticed in Target still quite a lot of out of stocks, particularly in the home area, which, of course, is famously much more from Asia than some other places. Kohl's also, same kind of situation. Certain categories appeared to be particularly light on inventory. The one thing that I thought was really, and again, this may be specific to some of Kohl's or Target's issues, not broader, but Kohl's, in the front of their store had this big Christmas holiday section set up. First thing you see when you come into the right, quite a large 1,000 square feet of seasonal items. Half of the shelves were empty. Now, maybe this is, like I say, it's a fluky thing. Maybe it's, they got to get through Halloween before they can, I don't know. Yeah. But so I'll be more interested.
Or reset, you caught them in a reset.
Yeah, but it is the front of the store, and it is late October. So presumably they would have those goods. But anyway, I will, we'll be back in the stores as we get into the heart of the holiday season, as well as, watching some of the retailers we like to watch. But I thought that was pretty interesting and is not really a positive sign for the future.
I too want to pick up on one of your threads, and it's not very positive. This Farmageddon is just building and building and building. My podcast partner, Dr. Sylvain Charlebois, was at Purdue University this week doing a keynote, and he was sitting down with a bunch of farmer representatives, and they're very, very worried. And this is Indiana, right, the heart of the farmland. Yeah. They've sold nothing to China in terms of soybeans, and it was a record crop this year. So there was tremendous optimism heading into the year, because farmers sometimes have good crops and bad crops, and they were like, great, we're finally, we'll make up our money. They're, beyond worried. And, the effect of their spending, we talk about the coasts, but in the middle of America, this, even if they get a bailout of some $15 billion, that's just going to keep their heads above water. They were all had invested based on, we're going to have a great year. And so I really worry about their spending in retail. I worry about a bunch of other things, but their spending in retail, has a long-term impact. And of course, they were all talking about, there's a lot of people, you brought up last week, there's a lot of people in America who are not getting a paycheck. And, the military, for example, as you pointed out. So, just another, it's more than a headwind. I mean, it's just a big drag on performance heading into the holidays. So if I was a retailer, I'd be pretty concerned and maybe adjusting price strategy. So I'm going to keep an eye out to what retailers and how retailers are going to react, and particularly middle America, but also, throughout the States as they find consumers just pinched in terms of discretionary spending income. Anyway, not very positive, but that's what I'm keeping my eye on in the weeks ahead. All right. Well, that's a wrap on this episode.
Thanks for tuning in. To help more retail leaders discover the industry's leading podcast, please drop us that 5-star rating and review on Apple, Spotify, YouTube, or wherever you enjoy your pods. And for more on my strategic advisory services, keynote speaking, best-selling books, and even more retail industry insights, go to stephenpdennis.com.
If you are a brand or service provider looking to take your influence to the next level, reach out to us for sponsorship, advertising, or event partnerships. And if you want to learn more about my own keynote speaking and advisory practice, reach out to me via LinkedIn.